Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to Fitch Ratings Fixed Interests podcast. My name is Justin Patrie, your host today. Asset bubbles are a growing theme among investors as a combination of surging equity valuations, tight credit spreads, rapid growth in AI-related investment, and concerns about potential hidden risks in the private credit market have all come together in the second half of the year. Could leverage finance, the part of the market that generally refers to borrowing by sub-investment grade borrowers, be one source of bubble risk? Well, to help me answer that question, I'm pleased to have with me two guests to our podcast, Lyuba Petrova, who is a managing director at Fitch Ratings and heads our global leverage finance team, and Lyle Margolis, senior director and head of private credit in Fitch's corporate ratings group. So Lyuba, let's start with you. Your team frequently comments on credit performance and market conditions in the leverage finance space. Are you guys observing a bubble, and what factors are you looking at?
Well, Justin, given how constructive the market has been as of late, with all the spread compression and the abundance of dividend recaps and other opportunistic transactions, I get it. I can see how it may be tempting to cry bubble. However, when we look at valuations, which are a classic sign of whether there is a bubble or not, overall, we don't really see abnormally high numbers that would imply that buyers are overvaluing their targets. So according to Left Insights, which is a Fitch affiliate within the Fitch group family, who, by the way, do a great job of tracking this type of data, LBO purchase multiples for the second quarter were just over 8 times, which is down from 12 times from 2024 and 13 times in 2023. Now, pro forma adjusted debt for M&A deals, specifically those backed by leveraged loans, was just 4.1 times through the first lien and 4.4 times total. And this is at the lower end of the multi-year range. So in short, we're not seeing inflated valuations financed with aggressive debt amounts. We are also not seeing that excessive risk appetite is manifesting itself. If anything, we're seeing the opposite. So lenders really seem to be flocking to higher rated speculative grade issuers, which in turn results in meaningful compression in double B and high single B spreads. Conversely, triple C spreads remain at reasonable levels, with the option-adjusted triple C spread at around 900 basis points. This is nowhere near the tights of below 400 basis points that we saw when we were at the precipice of the global financial crisis.
Okay, so that's really interesting valuation data. But what about the documentation? We're always hearing of kind of there's always some news flow about another aggressive term in credit agreements. So what's kind of happening behind the scenes on these agreements?
Okay, true. That is very true. And it's also true that the pendulum with documentation really swings in tandem with the market sentiment and market technicals. So can the supply keep up with demand? However, I think it's also fair that we keep perspective. Credit protections in that documentation have been on a very long-term deteriorating trend for a very long time. And if we based our assessment on documentation in a vacuum without any appreciation for the context around it, then we would have to say that we have been in a bubble for the past 10 years. And I don't think that's quite true.
Okay, well, what about next year, though?
Now, for next year, we are forecasting continued improvement, which to a large extent is tied to what we view as more supportive Fed rate policy. Lower rates will alleviate the interest burden that many leveraged finance issuers have been struggling with. And also, and as we have seen already, lower rates will support deal activity. And my view is that a formation of a bubble next year would really depend on how market technicals play out and if supply keeps up with the demand. And it's also worth considering the extent to which competition with private debt impacts lender behavior in the public markets.
Yeah, can you develop that point? Because that's something we're hearing a lot more about is that competition between private credit and the public markets.
Well, private debt has evolved into an alternative to BSL. We have all seen private debt establish itself as a mainstay alternative. But its existence, I think, is a double edged sword. On the one hand, it provides stability and respite at times of risk aversion and volatility in the broadly syndicated loan market. But at the same time, when times are good, private debt and the broadly syndicated loan market often end up competing for the same deals. Now, this means that they will likely need to compromise on leverage or on underwriting standards. It could become a race to the bottom, and that could create conditions for the formation of bubbles.
Hmm. Well, we've started talking about private credit, so let's turn to Lyle, our head of private credit in our corporates team. Lyle, kind of similar question as I started with Lyuba. Are you seeing signs of a market bubble in the private credit space?
Yeah. Hey, Justin. Yeah, I would say for the most part, the answer to that would be no. But there are some areas that we do think bear watching. There certainly seems to be more demand for loans than supply, given the weak M&A market over the past couple of years. But lenders have really held somewhat firm on three key terms, which is why we don't think a bubble is currently brewing. First of all, middle market LBO leverage is near the low end of the historical range. So they're not really compromising on leverage. Secondly, pricing has come in along with BSL, but the spread pickup going from BSL to private credit is still near historical levels. Think 150 to 200 basis points. And then lastly, all the middle market deals that we see continue to have a leverage covenant, so they're not compromising on the covenant terms.
Okay, so you make a good case on why it's still a no, but you mentioned some areas that are worth watching or bear watching. So what are those areas, and can you kind of develop that point a little bit?
Yeah, sure. So, we do see a lot of roll-up activity in the direct lending market, and that's resulted in asset managers chasing the same ideas, if not the same deals. So everybody wants to invest in issuers with highly recurring revenues that are recession-proof, AI-proof, and we find that that's causing strong pockets of demand in certain sectors. So, for instance, since 2021, we've seen the number of issuers in one of our private credit portfolios jump in subsectors like car washes, veterinary practices, HVAC servicers. And for instance, like the portfolio has grown 45% in that time, while the number of HVAC servicers is up over 1,000%. So, the source of our concern here is the multiples being paid for some of these businesses, in our view, are really getting into bubble-like territory. Mom and pops in these industries can sell for lower multiples, but we're seeing bigger companies trade for multiples in the mid-teens, which isn't really supported by public comps. Now, that's not to say that there are a lot of comps out there. There are actually no public HVAC servicers or even pure play veterinary practices out there. But the one public car wash operator, it went public about 4 years ago at a 30 times valuation, but has lost nearly 2/3 of its value and now trades around 8 times. And when you're levered up, we see some of these deals levered up, 7 times or so. That doesn't leave a lot of room for error.
But that sounds like it's more of an equity problem than a debt problem, or is it?
Yeah, it is until it isn't, right? If a sponsor thinks that they have significant equity value in a company, they're more likely to support it. But if that equity value disappears, the incentive to support it can evaporate with it. And we saw some evidence of that about a year ago when a private company called Zips Car Wash filed a public bankruptcy, as the sponsor walked away rather than continue to support the company as its loans matured. And in that case, the lenders took control of the company in Chapter 11. And according to the bankruptcy docs, they took a 25% loss on their loan, which I do think illustrates the risks involved when valuation expectations are just too high.
Well, thank you very much, Lyuba and Lyle. That was very informative. And as always, thank you very much to our listeners, if you would like to learn more about Fitch Ratings credit views and analysis, including dedicated sections covering our bubble risk and private credit research, please visit our website at fitchratings.com.
Subscribe to Fixed Interests wherever you get your podcasts.